Across the U.S., and particularly in Florida, home builders are stopping their projects amid a flood of houses and weak demand. Streets are lined with structures that stand half-complete, eerie monuments to a market that's echoing the collapse of the mid-2000s. In Florida, this glut of properties is causing home prices to plummet, an ominous repeat of past financial disasters. What happens when the bottom truly falls out of Florida's real estate market? Join us to find out as this unfolding crisis deepens. Before we get started, thank you for liking and sharing these videos. It really helps out the channel, and consider subscribing so you don't miss these regular updates. In Florida, the inventory is growing, especially in areas like Orlando, presenting potential opportunities for buyers who are willing to wait. The downturn in tourism has impacted Airbnb owners near Disney World, forcing many to sell their properties. This has increased the number of homes available on the market. As we look forward, home prices are expected to gradually increase by about 3 to 4% by the end of next year. This indicates slow and steady growth, suggesting a solid environment for potential buyers and investors. Few predicted this unexpected influx of homes on the market, given the persistent low inventory and high home prices over the past 3 years. Yet the current reality is that in places like Orlando and Lakeland, interest in available homes has dwindled. Prospective buyers can gauge this lack of interest on platforms like Zillow, where homes linger on the market for weeks without a single save, indicating minimal buyer engagement. Moreover, migration to Florida, which had been robust over the past couple of years, is showing signs of slowing down. Despite Florida still ranking as the top destination for movers in 2023, predictions for 2024 and 25 suggest a significant decline. This slowdown is problematic for builders who rely on a steady influx of new residents to support the housing market. You can see houses closely packed together around Florida's neighborhoods, typical of new developments. These 3-bedroom, 2-bath homes are listed between $350,000 to $380,000, a price range still too steep for many. Considering local incomes hover around $65,000 to $70,000 annually, these homes are unaffordable for most residents and even for those purchasing second homes. Consequently, prices must fall to align with what buyers can afford. This adjustment process can be frustrating for buyers watching the market as they see more homes listed and price cuts starting to happen. However, some sellers and builders are reluctant to reduce prices significantly. It's not uncommon to see homes listed for 6 months with minimal price adjustments, or in some cases, prices are even raised in a misguided attempt to spark interest. This stubborn pricing strategy might delay the necessary market corrections, but the overwhelming supply suggests that significant price reductions are inevitable as builders and sellers strive to attract buyers in an increasingly competitive market. It's generally expected that sellers take some time to adjust their strategies, but the fundamental market dynamics eventually take precedence, a concern particularly prevalent in Florida as well as other housing markets across America is the inflated state of home prices. These prices are considerably higher than what local incomes can support. When prices escalate beyond income levels at a rapid pace, it indicates a potential housing bubble. This could stem from various factors such as excessive mortgage debt, government interventions in the economy, or a temporary influx of wealthy individuals driving up prices. Despite arguments from some that their local markets are exceptions due to factors like new residents, foreign investors, or other unique circumstances, the reality suggests otherwise. The impact of these groups is diminishing. The market is seeing a decrease in investors and a notable drop in foreign buyer activity, reaching some of the lowest rates in a decade. As these external pressures fade, local buyers are left grappling with prices that have soared out of reach. For instance, in areas like Lakeland and its neighboring town Davenport, home prices seem to be 35 to 40% above what long-term norms would suggest. This pattern of overvaluation is not unique to Lakeland. Similar trends are visible in Orlando, Miami, and Tampa. However, an overvalued market does not necessarily indicate an imminent crash, just as an undervalued market does not guarantee rising prices. It's crucial to observe if your local market is significantly overvalued and experiencing a surge in listings and inventory. Such a scenario could indicate substantial declines in home prices. This was evident during the housing crash of 2007 and 2008, and some markets in Florida today are showing signs that may predict a similar downturn. Builders are also experiencing mounting pressures, with mortgage rates consistently high around 7% and a decline in buyer interest. They're left with an increasing inventory of completed but unsold homes. This resembles the situation in 2010, a national trend that signals a potential market correction. The halt in construction activities in some regions further highlights the surplus of unsold inventory. Moreover, the rising rate of foreclosures is an imminent concern. Although the default rate may not reach the previous high of 10%, even an increase to 5 to 6% could seriously destabilize the market. The current rate stands at about 2 to 3%, and a huge rise could further saturate the market with homes, worsening the issue of high inventory amid dwindling demand. For potential home buyers in Florida, the current environment might present a good opportunity to secure deals in the coming months, especially in areas like Lakeland, Orlando, Tampa, and Sarasota, which are witnessing notable downturns. In contrast, regions like Miami-Dade County might experience a slower price adjustment due to an ongoing inventory shortage. Currently, the home building sector is exhibiting trends that have historically led to market crashes and 6 economic recessions in U.S. history. These builders are finishing numerous homes that are now hitting the market, causing a surge in available inventory. You see, there's an unusually high supply of builder lots, with 9.3 months of inventory available, one of the highest ever recorded. Reuters reports that the nation is now seeing a 16-year peak in the supply of houses from builders, particularly in the southern U.S. In this region, the number of new homes for sale has surpassed levels seen during the 2006 housing bubble, which preceded the most severe market crash in recent memory. This raises concerns about the potential severity of the upcoming downturn and its implications for the broader U.S. economy. Historically, when builder supply reaches such elevated levels, it often precedes an economic recession within the following 6 to 12 months. This pattern had only one exception in 2022, which narrowly avoided a full recession. Now, another factor many people overlook in this situation is the impact on construction jobs. As builders face an oversupply of homes, the need for new construction diminishes, leading to reduced demand for construction workers. This could mean that layoffs in construction might be among the first signs of broader economic troubles as the nation heads into the latter half of 2024. Florida is a hotspot for these trends. The state's housing market has begun to slow, with inventory levels soaring and prices starting to drop. This is especially pronounced in Palm Beach County, which has returned to pre-pandemic inventory levels. Sellers here are reducing prices at record rates, which is significant given that Palm Beach is one of Florida's most affluent markets. Interestingly, despite these market conditions, demand remains relatively stable, especially among cash buyers, primarily older individuals moving from the Northeast. This group is less affected by economic downturns and high mortgage rates, which stabilizes demand somewhat. However, the overall increase in inventory and the ongoing price reductions indicate a significant market correction on the horizon. It's important to understand that housing market downturns typically unfold over several years. Historical patterns suggest that the peak of market prices to their lowest point can take around 5 years. Each local market in the U.S. experiences these cycles differently, with some areas seeing prolonged periods of price declines, while others might maintain stability due to low inventory levels. For those watching the market, particularly home buyers and investors, it's crucial to observe these trends closely, focusing on local market conditions rather than national averages. The housing market is complex and varies significantly across different regions, with some areas showing signs of sustained demand and price stability, while others face sharp downturns. Many people who moved to Florida during the pandemic were drawn by the state's warm climate, escaping from colder states. However, the intense heat and humidity of Florida's summers have surprised many newcomers, prompting some to reconsider their decision to stay. A vivid description shared by someone perfectly captures what it's like to live in Florida during the summer. It's like taking a shower, skipping the towel, getting dressed, and stepping outside. You feel perpetually damp and sticky. Kauter Homes, a premier builder in this area, offers quite pricey properties, with homes ranging from $700,000 to over $1 million. Furthermore, these homes are located in relatively remote areas on the county's western side, which typically wouldn't command such high prices due to their isolation and lack of nearby amenities. Understanding the local market dynamics like inventory trends and price adjustments is more important than ever. By analyzing specific data from one's city, state, or zip code, one can gain a clear picture of the market conditions, helping make a more informed decision regarding such a substantial financial commitment. Moreover, the broader economy influences the housing market. For instance, the Builder Supply Index, a leading economic indicator, has historically signaled recessions when it rises above certain levels. Except for the anomaly of 2022, every spike in this index over the past 50 years has preceded an economic downturn. Currently, various economic sectors mimic the patterns seen in home building during the pandemic. A rapid increase in supply followed by a sudden drop in demand. This is evident not just in construction, but also in manufacturing and retail. Consumer confidence is waning and retail sales have stagnated. Such conditions typically lead to recessions and could mean deflationary trends in the coming months. When you buy a house in the US, you generally expect the value to go up over time. Even after considering the effects of inflation, the trend for home values is typically upward. This can be seen in a chart from the Long-Term Trends website, which uses data comparing the Case-Shiller Home Price Index to the Consumer Price Index. When you own a home, it usually becomes more valuable over time, unlike money, which can buy less over time due to inflation. Buying a house often involves saving a lot of money and taking a big loan that you pay back slowly. This is different from renting, where you only pay rent every month. Owning a home not only gives you a valuable asset, but it also gives you security for future loans, like starting a business or paying for your kids' education. Later, you might sell the house for more than you paid. Owning a home also means stability and a secure place in society, especially for the middle class, which represents the middle 60% of the U.S. population in terms of wealth. A large portion of their wealth is tied up in their homes. This is why home ownership is often viewed as a crucial step towards financial security in the U.S. It's seen as a way to not only secure but also enhance your wealth. However, the challenges associated with purchasing a home in the U.S. are making it harder to buy. Just how much more difficult has it become? And what implications does it have for your future if you can't buy a home? Let's explore this further by revisiting the median housing prices in the U.S. over the past 5 decades, up to 2022. We'll also examine how incomes have changed over this period. As we see, median incomes have not risen at the same rate as housing costs. This is where Michelle Dickerson comes in. She investigates the growing difficulties faced by lower and middle income individuals in achieving and maintaining a middle class status. Going back around 50 years, let's consider a couple whose combined yearly income was precisely at the national U.S. median back then, around $10,000 in 1972. Imagine them trying to buy a house when the median price was about $29,000, roughly 3 times their annual income. Before the 1980s, it was fairly common for a young person to finish high school, secure a full-time job with benefits, and earn enough to buy a home. And after decades of crisis after crisis, owning a home is looking like a far-fetched dream. In 2022, let's examine the numbers: the average income and the average price of a house. Nowadays, a house costs more than 6 times what the average household earns. This sharp contrast is what we see when we revisit the chart comparing income and house prices, all adjusted for inflation. Zooming in on the data, let's update our view to 2023. It appears that house prices are beginning to decrease slightly. However, the reason they escalated so significantly in the first place ties back to a shortage of available homes. A chart showing the homeowner vacancy rate over the past 70 years reveals that the percentage of homes for sale in the U.S. is at an all-time low since records began. This scarcity is partly due to stringent zoning laws, which are local regulations that dictate where houses can be built, how many units a building can include, and how densely areas can be developed. These rules lead to fewer houses being built, which in turn means fewer houses available to purchase. Focusing on the homes that are actually on the market, let's break down the data. The chart categorizes all homes for sale in the U.S. into different price ranges. It tracks how each price tier, low-cost homes versus high-cost homes, has changed over time in terms of the market share. Over the last few years, homes priced under $200,000 are becoming increasingly rare, while those priced over $500,000 or even $1 million are taking up a larger portion of the market. This illustrates that not only is housing in the U.S. scarce, but also becoming exceedingly expensive. Yet there's a crucial element of the housing story that we haven't discussed. We'll delve into that after a brief interlude. Switching to another pressing financial issue, student loans. The statistics are alarming. Only 1 in 3 students fully grasp the financial terms of their loans. Furthermore, nearly half of those with federal student loans are unclear about how much they owe and to whom they owe it. This lack of understanding can exacerbate the financial challenges facing young Americans today, particularly about achieving home ownership. When one considers purchasing a house, the process generally involves 2 primary financial steps. First, an initial down payment is made, which can range from 5 to 20% of the house's price. The remaining balance is then covered by a mortgage, which is paid back in monthly installments. The size of these payments varies depending on the mortgage interest rate, which has historically trended downwards over the past 50 years, making payments more affordable when rates are low. However, housing price trends tell a different story, generally indicating an increase in the difficulty of buying a home over time. These 2 factors, interest rates and housing prices, tend to move inversely, except in unusual circumstances. For example, the pandemic in 2020 caused a surge in movement and a sharp increase in home prices. Similarly, efforts to control inflation in 2022 led to rising interest rates, which have remained high along with high housing prices. This high-cost environment is exacerbated for people of lower income or poor credit scores who face higher mortgage denial rates. Websites like Zillow analyze these elements to calculate the heavy financial burden on new homeowners, which currently stands near record highs. The fluctuating market raises the question of whether financial stability can be achieved without home ownership, especially given the sharp decline and recovery in home values during the 2008 crisis and similar patterns in other investments like the stock market. Viewing a house as a long-term investment shows that it isn't necessarily more lucrative than other options, such as government bond mutual funds, which typically offers more stability. Is the American dream of homeownership still viable, or is it becoming a financial trap for the modern buyer? Leave your thoughts in the comments, and don't forget to subscribe for more insights.